Hi, I'm Profi, and we're continuing our series here on the principles of macroeconomics, this time looking at government budgets and fiscal policy. So what I want to do in this video is first review the structure of government budgets and taxes, just so we have a good general sense of how these things work, the types of things that are included. Then we'll look at how fiscal policy fits into an aggregate supply, aggregate demand framework. And finally, we'll look at some practical limitations faced by trying to use fiscal policy. So first, how does spending get divided? So I'm going to focus here on the federal level, or I think it's probably better to call it the national level. First thing we think about is whether spending is mandatory or discretionary. So mandatory spending would be that spending that is not set year to year. Instead, legislation has already mandated, thus the name, right, how much is going to be spent on this particular policy. So for example, something like the Social Security system, Medicare, these types of expenses are things that don't change year to year based on legislation. Instead, they change just based on the structure of the program. But we don't have every year having to figure out how much is going to be spent. Then you have discretionary spending. Now, discretionary spending, we do make an explicit decision about every year. That would be part of the government budget, or whatever they want to call the resolution in that particular year, right? So typically one of the largest single expenses in the discretionary side of things would be defense. Defense is often roughly half of the discretionary budget, and then very special stimulus measures, anything related to that, right? So if the economy happens to be going through a hard time, so we have some kind of stimulus program, that would also be considered discretionary. And then also other spending fits under this. So just things like running the Department of Agriculture would be part of the discretionary spending for the most part. Now in the United States, while it is true the discretionary spending, roughly half of it is defense, most of the spending, though, total in the US is mandatory spending. Somewhere in the neighborhood of 2/3 or so is mandatory spending. Now, with taxes, again, we have a number of different sources of taxes. In the United States, we use some combination of income and payroll taxes, and then some excise taxes. Those would be things like sales taxes, similar to sales taxes anyway, and then tariffs as well. Now, between these sources of income, and there are also things like estate taxes and the like, which tend to be very small. But by far the most important source of government funding would be individual income taxes and payroll taxes. It is by far the most important source of government funding in terms of how many dollars come from it. And those two things, income taxes and payroll taxes, are followed far behind by corporate income taxes. And then well below that, right, would be our excise taxes, tariffs, and estate taxes. Now, when we look at taxes, one important distinction to make is the distinction between an average tax rate and the marginal tax rate. So your average tax rate is the total taxes that you pay divided by your total income. While your marginal tax rate would be the tax on the marginal dollar, right? So what is that? If you just earned $1 more of income, how much of that has to go to taxes? Right, so these two rates are going to be different for nearly everyone, with the exception of some people that don't pay taxes, right? That be it. But outside of that, these are generally different, with marginal rates being significantly higher than average rates for most people. And so here's just a simple example. So suppose that we have a tax system in which the first $20,000 is untaxed, right? So you can claim that as a total between personal exemptions and standard deductions. So you earn $20,000, you don't actually have to pay any taxes at all. But then for the sake of simplicity, let's say every dollar after $20,000, so the $20,000 first dollar up to however much you earn, is going to be taxed at 20%. Right, so let's say you earn a $50,000 income. Well, in that case, the first $20,000 is not taxed. The other $30,000 will be taxed, right? So you pay 20% of that $30,000 or $6,000 in taxes. So for this particular person, their average tax rate would be the $6,000 they paid divided by the total $50,000 of income. So it's a 12% average tax rate. Meanwhile, the marginal tax rate is how much would they have to pay in taxes if their income went up by $1? How much additional tax would that be? Well, since they're already above the untaxed threshold, that additional dollar is going to be taxed at 20%. So we know their marginal tax rate is 20%. So here we see that difference. The average tax rate for this person is just a little more than half what the marginal tax rate would be for them. Now, another thing we talk about with taxes is who the burden falls on. Right? So we can structure taxes 3 different ways. Right? So one type of tax we'd call a regressive tax. So regressive tax is one where somebody with a lower income pays a greater percentage of their income toward that tax. A proportional tax is one where everyone pays the same percentage of their income regardless of their own level of income. And then a progressive tax is one where you pay a greater percentage of your income as your income goes up. So here's an example of a regressive tax. Right? So rather famously, sales taxes tend to be regressive. Because odds are, if you're relatively low income, you're probably going to be spending basically all of your income. Meanwhile, if you're high income, you're probably only spending part of your income. Right? So if we have person one, say they earn $10,000 a year, so they earn very little, right? And they spend it all. Well, in that case, because of a 10% sales tax, they're having to pay $1,000 in tax. That's 10% of their income. On the other hand, if somebody earned $100,000 a year and only spent 70% of it, so they saved $30,000 of that, now they're having to pay $7,000 in tax. Because they spent $70,000, they pay then 10% of that in tax as well. Right, so it'd be $7,000 in tax, that's 7% of their income. So you can notice here that the wealthier person is spending a lower percentage of their income on the sales tax than the person that earns less. Now, note here, in dollar terms, the person with higher income still pays more. However, the amount they pay is a smaller proportion of their income. Now, progressive tax might be something like, say, the previous example, where you have a 20% income tax, except the first $20,000 are exempt. Well, in this case, that first person that earns $10,000 a year, they don't have to pay any income tax at all. They earn little enough that they're within the exemption range, so in that case, they pay 0% of their income. Meanwhile, that $100,000 per year earner, they have to pay on the $80,000 beyond what is exempt. 20% of that would be $16,000, so they pay 16% of income. So you can see here the difference between the two, right? The relatively less wealthy person pays a lower percentage of their income than the wealthier person. Now, if you look at the American tax system on the whole, we have some elements that are regressive. So the payroll tax, for example, is one of those. And so the payroll tax, the way it's structured, right, is that, at least at the time of this recording, there are income limits, right? So, I'm paying into my Social Security taxes. Well, they only are going to tax up to a certain number of dollars of income. Everything above that is exempt from payroll taxes. Now, that means then it's going to be a regressive tax. So anybody who gets above whatever that threshold happens to be, right, doesn't have to pay additional money into the system. Right? Similarly, sales taxes, again, this tends to be regressive just because of the difference in savings rates. Now, I would note here in the sales tax case, right, there's nothing in the nature of sales taxes that makes it so they have to be regressive. It's just that in practice they are regressive because, generally speaking, the wealthier you are, the greater percentage of income you tend to save. Now, it's possible, right? You might have somebody who's relatively poor but extremely frugal. This person might, in fact, possibly manage to have a higher savings rate than somebody who earns more. This can happen. But in general, we would expect this to be a regressive type of tax. Meanwhile, other elements of our tax system are more progressive. Income taxes would be an obvious example here. Two main progressive elements there. One would be the existence of exemptions, so personal exemptions, and also personal deductions, as well as limits being placed on deductions. So all of that makes this much more progressive. Similarly, marginal tax rates are by nature progressive, right? So if you are in a higher tax bracket, that means each additional dollar you earn, you're going to be paying a greater percentage on. So by design, the income tax system is supposed to be, right, a progressive tax. Now, when you put all this together, though, we have some taxes, payroll and sales, that are regressive, some that are progressive. There are different estimates out there as to when you put this all together, whether it ends up more progressive or more regressive. At the very least, the data that I saw shows that for the most part, the overall tax burden tends to be slightly progressive at the federal level, but I've seen other estimates suggesting that when you add in the state level where you see more sales taxes, it might be a bit flatter, so it might actually be closer to proportional tax. But right now, as of my understanding at this point, right, we do have at least a slightly progressive tax system overall. Now, can you apply these same terms, progressive and regressive, to spending? Well, the answer is yes. Now, I would say I don't see the terms used this way, but in terms of meaning, it has a very similar meaning. That is, progressive spending policies would be something that tends to favor those with lower incomes, where regressive spending policies tend to favor those with higher incomes. So something like SNAP benefits, right, what we might traditionally call food stamps, these kinds of things, where we are targeting them toward those with relatively low income, then that tends to be progressive spending. Similarly, if you do something like, send a $1,000 check to each person in the country, this is actually going to be progressive spending, because as a percentage of income, $1,000 is a lot bigger percentage of somebody's income that makes, say, $1,000 a week versus somebody that makes $5,000 a week. Right? So, as a percentage, right, even just a flat everybody gets a check, right, is going to tend to be progressive. Now, when we look at the overall budget, so we put together taxes and spending, right, and we do the subtraction. So take your revenue, subtract off expenditures. What's that number at the end of the day? Well, if it's a negative number, that is, your expenditures are more than your revenues, then we would say you have a budget deficit. On the other hand, if it's the other way around, your revenues are more than your expenditures, then you have a budget surplus. Now, a balanced budget would be when the two cancel out, right? So you have your revenues are the same as your expenditures, so you do the subtraction, and it's exactly zero. Now, I want to distinguish here between two different terms that sometimes get confused, and that is the deficit versus the debt. Right, so deficit, we can think of that as a current value or a flow value. It's really about how much is happening right now. So right now, our spending is exceeding revenue by this much. Whereas debt is how much total, right, the government owes. Right? So effectively what the debt is, if you take all of those deficits we have over time and add them up, that would be the amount of our debt. After all, right, if we're spending more than we take in, the government, just like anybody else, you have to borrow the difference. Well, as you borrow that difference, your debt will tend to increase. On the other hand, if we run a surplus, then we can pay that debt down. Now, when we talk about making the connection then, right, between fiscal policy, so taxes and spending, and things like the state of the economy, right, so aggregate supply, aggregate demand, we use these terms contractionary fiscal policy and expansionary fiscal policy. Right, so contractionary fiscal policy, its best purpose would be to fight inflation. Right? Now, how do we do this? Well, first, we'd only want to do it when our gross domestic product is above potential, because that's when we see the most inflationary pressures, right? So how do you have contractionary fiscal policy? Well, do two things. One, we increase taxes. If you increase taxes, that's going to discourage investment, it is going to discourage consumption. As we do that, that's going to bring GDP down and also decrease inflation pressures. A second thing we can do is decrease government spending. After all, government spending is part of GDP as we go out and we buy stuff as the government does that. If we do this less, then that is going to bring down inflation pressures, lowering aggregate demand. On the other hand, we have expansionary fiscal policy, which ideally would be used to fight recessions when our GDP is below its potential level. In this case, if we want to do this, we need to decrease taxes and increase spending. If we decrease taxes, people have more money to spend, they're more inclined to invest. If we increase spending, then that in itself adds into GDP as we buy stuff. Now, one set of policies that are designed specifically to be able to capture this automatically are what we call automatic stabilizers. Automatic stabilizers is that set of policies that appropriately adjust fiscal policy just based on the state of the economy. So a few examples of that. On the spending side, we have things like income, payroll, and sales taxes. So all of these have the trait where if the economy starts slowing down, right, then income's going to fall, consumption's going to fall. Right? As income falls, we bring in less income tax. As consumption falls, we bring in less sales tax, which means then, right, if the economy is slowing down, taxes are naturally lowering at the same time. So this is going to create this offsetting effect that should help stabilize the economy. On the other side, when we think about spending, unemployment compensation would be one form of automatic stabilizer. That is, as the economy slows, people lose their jobs. If people lose their jobs, they apply to get unemployment compensation, which means now the government is spending more on unemployment compensation. That in turn, that increase in government spending is going to help offset the slowing of the economy. Now, while it is true that in principle we do have these programs in place, the reality is that practically automatic stabilizers tend to be fairly small relative to the size of the economy. So simply having, say, oh, well, we mostly fund our government through income taxes and we have unemployment compensation, that's not going to totally stabilize the economy. Now, we also, thinking about automatic stabilizers, this does bring out the fact that our economy will affect what the fiscal picture looks like, right? So because a bad economy is going to increase spending on things like unemployment and decrease our tax revenues, we may see deficits arise simply because the economy is doing badly, right? So then we look at two different types of deficit because of that. Now, one form is what we call a structural deficit. Sometimes this is also called a standardized employment deficit. So the purpose of the structural deficit is to try to estimate what would the budget deficit look like if employment levels were normal. So if we didn't have to pay a whole bunch in unemployment compensation, right? Or if we weren't unusually earning a lot through payroll taxes because the economy is so awesome, right? So if the economy were normal, what would the budget look like? That's what the structural deficit would be. Now, if the structural deficit is zero, right, in that case, that means that as long as the economy is normal, right, we're in a perfectly balanced budget. If the economy is bad, then we'll have a deficit. If the economy is really good, then we'll actually have a surplus. Now, we also have what we call the cyclical deficit. The cyclical deficit is just that part of the deficit that happens because we're in a bad economy. Right, so the structural deficit is definitely much more concerning than just the regular deficit would be. After all, this is telling you that a good economy is not going to fix the budget deficit. If, however, you manage to get a structural deficit of zero, then that tells you, well, we only have a deficit because the economy is bad. Once it recovers, things are going to get fixed. So now let's look to some practical concerns related to using fiscal policy to try to stabilize the economy. So we're going to look at 4 different issues. Right, so one would be the problem of crowding out. We'll get into more detail on each of these in turn. Secondly would be lags. Third would be the difference between temporary and permanent policies. They can have very different macroeconomic impacts. And then finally, we'll look at some of the problems related to political motives that can make it challenging for us to carry out good balanced policy. So first, just the issue of crowding out. Right, so let's suppose that the government lowers taxes and increases spending. Or perhaps it just does some combination here. Maybe it increases taxes but increases spending more. Whatever it's doing, it's putting itself in a situation where we have a larger budget deficit than before. In that case, what's going to happen is we have higher interest rates. After all, if the government needs to borrow more, we have a big borrower that's entering now, that's going to increase the demand for loans. As the demand for loans increases, that's going to increase the cost of these loans. That's what interest rates are. Right? But then that creates this offsetting impact. Higher interest rates, then in turn, is going to lower the amount of investment that we see in the economy. After all, if I know I have to pay a higher interest rate on the loans that I'm taking out to build my factory, I'm much less likely to build that factory in the first place. So this is the essence of crowding out. Right? If government spends money that it's not bringing in through taxes, then it's going to crowd out investment as part of that process. Right? So, and now in order for this then not to happen, what fiscal policy would really need is coordination between fiscal policy and monetary policy. Now this is something where as long as we have monetary policy that's aiming at interest rate targets, this is something that's going to naturally happen. After all, if the government goes out and creates a need for additional borrowing that would push interest rates up, well, if the monetary policy is based on stabilizing interest rates, then they're going to put more money into credit markets in order to offset this. A second issue that can arise is lags. So we know that a number of lags exist in policy. Right, so first there's the data and recognition lag. Right, so the data and recognition lag, remember that's the amount of time that it takes for us to gather the data and then to recognize, interpret it, to know what it means. It usually takes several months for us to know how the economy is actually doing. Right, so we're always looking in the rearview mirror. Then we have the legislative lag, which in the case of fiscal policy, it varies. Generally in emergency situations, we do see the legislature gets its act together and passes things relatively quickly. But on the other hand, on a day-to-day basis, legislative lags can be quite long. Right? So usually, the legislative lag tends to be longer for fiscal than for monetary policy, where monetary policy tends to reach decisions much faster. Then we have the effectiveness lag. The effectiveness lag is how long does it take once the policy is actually in place to actually see results. Now this is something that varies a lot, really depends on the specific policy you're looking at, but generally for fiscal policy you see the maximum impact about 12 to 18 months out. So roughly 12 months or so is where you see the maximum impact. Right, so we have this issue where we're having to make decisions now about what the economy is going to look like a year from now. Well, we don't know what the economy would look like if we didn't make this decision. Right? We're having to make guesses. So we're looking in the rearview mirror because of the data and recognition lag while we are trying to drive, and we're trying to drive not just directly in front of us, we're trying to drive a year ahead of time. This makes it extremely difficult for us to effectively use fiscal policy to manage the economy in any kind of detailed way. Another problem we run into is that the difference between a temporary policy and a permanent policy. This is a point that Milton Friedman made. One of actually his big contributions was what we call the permanent income hypothesis. So the idea here is that people spend money based on their perceived permanent income. That is the amount of income you expect to earn over your lifetime. Right? So what that means then is that any temporary income tends not to have a big impact on your spending decisions. And this would help to explain lots of things. So after all, say early on in your life, right, so you turn 18, what probably happens for a few years? Well, you're probably going to be accumulating debt. Right? So you're borrowing to buy a car, you're borrowing to go to college, you're borrowing to buy a house. Right? So we have a number of ways in which we are spending money that goes beyond what our current income is. But then what happens? Well, after you get through these early stages in your life, you get to the middle of your life where you are paying these debts off. Right? So you're paying down your car payment, you're paying down your house, you are accumulating savings for a retirement account or something like that. Right? So all of this time, you are earning significantly more than you're spending. Then when you hit the last stage of your life, yes, your debts are largely paid off, but you want to retire. So when you retire, what happens? Well, now you don't have any income, but you are still spending money. You're spending out of your retirement savings, right? So what Friedman points out is that we don't change our spending decisions at each stage of life to match the income at that stage of life. Instead, we make decisions based on thinking about the entirety of our lives, which means then, right, that we are going to respond differently to policy based on whether we think it's going to have an impact temporarily or permanently. Right, so if we think that a particular change in policy is only going to have a temporary impact, it's not going to affect my spending decisions. Right, so something like, oh, we're going to give a temporary tax cut to try to stimulate the economy. Friedman would say this is not going to be very effective. If it's a temporary tax cut, people are not going to take this money and use it to spend on consumption. Instead, we're going to take this, we're going to use it towards savings, toward debt repayment. But savings and debt repayment doesn't provide much short-term stimulus, right? So you do have this issue where if it is something that is only going to have a temporary impact, it's generally not going to be a very big impact. Now, a last problem is political motives. So we have two different issues that show up under this general category of political motives. The first is the problem of pro-cyclical instincts. Right, that is, there's a great temptation for the political system to want to stimulate when times are good. Now, the reason for that is because of what automatic stabilizers do to the government budget. Right, so the government budget, when times are good, incomes are high, so we're earning lots of money, right, from corporate income taxes, from personal income taxes. At the same time, we're not spending much on things like welfare, things like unemployment compensation. So we're running either a very small deficit or running a surplus. Well, in that case, it really looks like this is a good time, right, for us to for us to increase spending or cut taxes. Right? So when times are good, we are tempted to do things that would tend to stimulate even more. On the other hand, when times are bad, we do exactly the opposite. That is, well, things are looking really bad because we're spending a bunch of money on welfare, we're spending a bunch of money on unemployment compensation, while at the same time, we're not bringing much in terms of income taxes or sales taxes or whatever it happens to be, right? Which means then we have these big deficits. Well, we need to solve the deficits, so we're going to raise taxes and cut spending. Right? So typically, we would say, well, what happens when you cut spending and raise taxes? This is going to tend to lower aggregate demand and tend to stifle the economy. Right? So there is this tendency for the political system, just because it's worried about keeping the budget more balanced, to try and enhance or magnify the effects of the business cycle through these pro-cyclical instincts. Now, a second issue that shows up with political motives is just a general bias toward having deficits. The reason is fairly simple. Right? So if you ask an average person, oh, are you worried about the government deficit? Many people will say yes. Yes, we don't think it's good, right? The government's spending more money than it takes in taxes. All right, well, in that case, you'd be okay if I increase your taxes. Well, not so fast. The reality is that taxes are politically unpopular, right? So trying to increase them is very, very difficult to do. Then you have the problem on the spending side. Well, okay, maybe we can't balance the budget by increasing taxes, but maybe we can cut spending. Well, again, in principle, people are perfectly happy with cutting spending as long as you're cutting somebody else's program rather than their own, right? So again, that makes it difficult to actually cut spending because every time you do, you're going to hurt the person who's receiving that spending. Right? So on the one hand, taxes are unpopular. On the other hand, spending is popular, so it creates a lot of tendency for us not to tax enough to cover our spending, and we end up with deficits. Now, if we add to this the power of special interests, it tends to get even worse. Right? So special interests certainly don't want to be taxed, so they're going to lobby very hard against any taxes that affected them. At the same time, they may benefit from spending. Right? If they do benefit from spending, they're going to lobby hard to make sure that spending happens and doesn't get decreased. So put all that together, and that makes the deficit bias even more severe. Right? So because of this, it's not so obvious that we're going to see the political system or legislature be able to manage fiscal policy in a way that will help offset the business cycle, as that goes against their instincts and also goes against the political incentives that they face. So a quick note then on the idea of balanced budgets. So the reality is that the large government debts that can be accumulated because of this deficit bias can result in significant problems, and in some cases it can even reach the level of being a crisis. So then, would we want to have some kind of balanced budget requirement to prevent that from happening? Well, as is true of most things in economics, maybe. Right. There are pros and cons, right? Benefits and disadvantages. So, what are some of the pros? Well, the big pro is that it's going to place limits on political motives that create systematic deficits and pro-cyclical fiscal policy. After all, if it's required that every program has to be self-funding, right? So you can't pass a piece of legislation without knowing how much it's going to cost and also how you are going to pay that cost by either cutting another program or raising taxes. In that case, political motives for systematic deficits, well, in effect, get turned off, right? You cannot act on them anymore as long as you have this type of policy in place. Similarly, pro-cyclical fiscal policy, where you're going to increase spending without increasing taxes or decrease taxes without decreasing spending, right? Those types of things, we're not going to see that happen if we do have this kind of requirement that we hold the budget balanced. However, a significant con is that this means that we can't enact counter-cyclical policy, which means then we lose the opportunity for long-term investments, right, if we're trying to balance year by year, right? So one thing that the counter-cyclical policy can do is we can say, well, yes, we want to do something like build a new highway, or perhaps not build a new highway, but just maintain our highways. So do road construction, something like that. Now, it seems reasonable, right? We would want to do this when there's lots of unemployment. After all, that means there are more workers out there. It means the wages we have to pay won't be quite so high. So we can make this kind of investment right now when times are bad, right? And it's going to pay dividends through the future because we'll get to drive on this road for who knows how many years. And so, but that requires the ability to spend the money now, even if the income is not here now. Right? And that's the issue with any kind of investment. Investments, you have to spend money up front, they'll pay off in the future. And that's something that's in effect impossible to do if you're forced to follow a balanced budget. Now naturally, how the pro and the con balance out very much depends on two things. So one would be the empirical question of how big are these effects that I'm mentioning, and secondly would be just kind of it's not so much an empirical question as I guess the normative question of should we try, right, to use countercyclical policy or not, right, given its other limitations. It might just not be worth it for much of the time, or maybe it is worth it. And this is a point about which there certainly is disagreement amongst macroeconomists. So then just a couple final notes as we talk about fiscal policy, right? So one would be that I think it's fair to say that on average, most macroeconomists would today prefer monetary policy over fiscal policy if the goal is economic stabilization. The big reason for this is that it's more insulated from short-term politics. And so the people that are sitting on the Federal Reserve Board, they have 14-year terms potentially, right? So they're going to be there for a while. They're not running for election on a regular basis or anything like that, right? Also, we have shorter decision lags because they meet roughly every month or so, right? Sometimes it's slightly over a month, but roughly a month or so is how often they'll meet, right? So we're going to see decisions made reasonably quickly, implemented reasonably quickly, and also we wouldn't expect the political motives to be quite as severe for monetary policy as it is for fiscal policy. However, there are some exceptional cases, and this is setting aside, right, certain views. So there are certainly some views out there that just reject monetary policy entirely. So watch my video on the Austrian view, for example, would certainly be skeptical of the idea of using monetary policy for economic stabilization, period. Now you do also have, most Austrians would not be a fan of using fiscal policy for that same purpose, but nonetheless, right, there are those that say, no, we think the monetary policy may have more negative effects potentially. And there certainly are some that actually believe fiscal policy is quite helpful, right? So there certainly are, right, either end of the spectrum on this. But I think amongst most macroeconomists, you will still see most agree there are exceptional cases where fiscal policy would be useful. One would be if you have a large and a long recession. Right? So if it's large and long, that means it's large enough that we would have to have some doubts about whether our just automatic stabilizers are going to do much good for us. And if it's long enough, then we're not so worried about the lag problem. Right? So in that case, if it is both large and long, then it may make sense, right, for us to think about putting more fiscal policy measures in place. A second exceptional case would be when interest rates are at the zero lower bound. So I think it's fair to say again that most macroeconomists would say that once monetary policy hits where interest rates are at a zero lower bound, it's very difficult for monetary policy to do much more to stimulate the economy. So yes, we can provide lots of reserves to the banking system and hope that they then lend these out, but we really can't do much in terms of interest rates in order to actually change people's behavior. So in that case, we have to rely, right, more on fiscal policy to pull off, right, whatever kind of recession recovery we're trying to induce. So I think that wraps this up reasonably well. Thank you for watching. All the best.